Bloomberg Audio Studios.
Podcasts, radio, news.
Hello and welcome to another episode of the Odd Lots podcast. I'm Tracy Alloway.
And I'm Joe Weisenthal.
Joe, what do you know about creditor-on-creditor violence?
I don't know anything.
Other than it's a very punchy term.
That's literally it. It's come up a few times it's come up a few times in episodes we've done about credit. And I get the impression that, lenders to a firm have different status and some are higher up in the rank than others. And that they would like to probably use the technicalities of the legal code to improve their rank in some sense when money gets paid out to lenders.
Yes. So it has come up in a number
It's not really violence, is it?
Well,
Okay.
Some of the fights get pretty nasty.
Okay.
Well, so when I think about it, I think back to when I covered the leveraged loan market at the FT, and this was sort of like 2013, 2014. And I remember writing stories about how leveraged loans, more of them were becoming cov-lite. Weaker covenants for lenders or investors. And what that means is companies basically had more leeway to restructure their assets if they were trying to raise new capital or stave off bankruptcy or whatever, at the expense of those lenders/investors. And back in 2014, I think the proportion of the leveraged loan market that was cov-lite was something like 30%. And that was like a big deal. That was already higher than the leveraged buyout boom in 2007.
Yeah.
Now, the vast majority of leveraged loans, I think something like 90%, could be called cov-lite. So the entire market is basically cov-lite at this point, which fits into the creditor-on-creditor violence theme. So I feel like we need to dive into this.
What it is, my impression is that if I'm going to be a firm that buys leveraged loans, I need a good lawyer to look over the contract.
Well, I kind of wonder. I guess I wonder relatively how important like legal expertise is versus valuation expertise.
This is what I am wondering as well.
All right. So let's get into it. I am very pleased to say we have the perfect guest. We're going to be speaking with Sujeet Indap. He is, of course, the Wall Street editor over at the FT, my former colleague. We used to double byline on at least one piece, I think. He is also the author of the excellent Caesars Palace Coup book, which if you haven't read, I would highly recommend, especially on that point about distressed debt fights getting kind of nasty. Sujeet, thank you so much for coming on All Thoughts.
Hi, Tracy. Hi, Joe. It's great to be here.
Thank you.
So I guess my first question is, we see these headlines about creditor-on-creditor violence, or, someone will be writing about the private credit market and there'll be an aside about creditor-on-creditor violence and how it's becoming more of a thing. Can you give us some context around whether or not this is becoming a bigger trend? I feel like it is, but it's not like there's a violence index that we can look at.
Yeah, so the idea of violence in corporate restructuring and private equity deals is not a new idea. Imagine the business that's been bought by the private equity firm is just less valuable over time. The pie has shrunk. There's going to be a fight over who gets what piece and how big those pieces are. The creditor-on-creditor violence phenomena, though, is a little bit more nuanced and novel. And that's the idea that, imagine you, Joe, you, Tracy, and me, we are all holders of the first lien term loan. Let's say you own $500 million, Joe, you've got $300 million. Let's say I'm poor, because I work at the FT and only have $15 million. But there would be the view that since we're all in the same security, governed by the same document, that our rights are the same. And we are all going to be treated equally in this fight with the private equity firm and maybe the junk bond holders below us. The creditor-on-creditor violence nuance now is that, in fact, we are not equal. And you two, as large holders, can do things to me, small holder, that are not equal in treatment, arguably unfair, arguably impermissible.
Just to be clear, in this theoretical setting in which all of us are, quote, equal in the firm's liabilities, did we all have the exact same language did we all enter into the same contractual language when we purchased the debt or when we lent money to the company? And furthermore, if we did all have the same language, what are the tools that we use to change our priorities?
Yeah. So we do. We all are governed by the first lien credit agreement. Maybe you bought in the original LBO, and maybe your CLOs, and I'm or you are a distressed debt hedge fund which bought in later at a different price. But we're all governed by the same document, and in concept have the same rights and protections.
So then how do I do something to you guys what are the basic tools at my disposal if I want to somehow gain an advantage for me that doesn't accrue to you?
Yeah, so let's talk about like why that scenario would first arise. And imagine the company is running into trouble. There's a maturity coming up, or there's some liquidity challenge. As you said earlier, these documents now, since the financial crisis, are covenant-lite or no covenant. So there's a lot of flexibility for the borrower, which is the company and the private equity firm that owns the company. And rather than just declaring bankruptcy and going to bankruptcy court and fighting out there, which is messy, it's time-consuming. It has its own restrictions on what you can do, and the private equity firm will typically, if you're the equity holder, will get wiped out. Bankruptcy is like not an attractive option for those reasons. And so what you can try to do is raise new capital. And you're going to raise new capital, often from the existing lenders. And those lenders, in exchange for giving you more money, are going to ask for some things. What are they going to ask you for? First, the company itself is probably going to want to reduce the principal balance. So they want people to take haircuts. So there's going to be some haircuts involved. And then there's going to be this new money brought in. That new money, however, if I'm giving you new money into this troubled company, I'm going to want some things to do that.
Got it.
And those things I'm going to want is the most senior priority, which is called super priority. Okay, that's all sort of standard. That's not new. The nuance is the company itself has some amount of value it can pass out as cookies in this new financing process. And in the old world, what they would do is, let's say I've got $100 million, and I'm making that number up, a value to allocate in this new transaction that I'm going to raise new money in. Rather than splitting that up pro rata amongst the three of us, I'm just going to give it to two of you. And so why is that? From the company's point of view, it's $100 million. How the three of us divide it up, they don't really care about. But you two care about getting as much as you can, since you own well, we all care about it. But you guys have the possibility of being, let's say, a 51% group and saying, I can take all the cookies for me and leave Sujeet behind. And that is the idea of creditor-on-creditor violence. We are theoretically pari passu. We are in the same place with the same document. But because you choose to and the sponsor doesn't really care, the sponsor will just go to you. It's easier to deal with cuts since there's two of you, not three of us to negotiate with. And that is the nuance of creditor-on-creditor violence. You two, theoretically, standing with me with the same document, can impose pain on me simply because you're bigger.
Super priority kind of reminds me of double secret probation, right? Like I wonder, can you have like super priority? That would, I guess you could like keep doing it forever pretty much, or at least until all the collateral
Well, yeah, you
is
see these
exhausted.
kind of like 1.5 lien that's kind of put between first and second. And then there's been, double creditor-on-creditor violence cases. So there is like this spiral and kind of like through the looking glass.
Violence squared.
Yeah.
So one thing I don't really get about the creditor-on-creditor violence is its connection with private credit. And I've seen people talk about private credit as a response to creditor-on-creditor violence, in the sense that, maybe it's easier to be a single lender to a company. You're higher up in the payment waterfall. You don't have to worry about getting into fights with a bunch of other investors. But then I also see headlines saying that creditor-on-creditor violence is becoming more of a thing in private credit too. So basically, I'm confused.
Yeah, so let's just take a step back and just think about that. I think there's two factors that are behind the generalized creditor-on-creditor violence concept. One is what we hit on before, which is just the technical aspect of these credit agreements, which is the legal contract that governs like a leveraged loan. And then, what are the restrictions or covenants that are in that document that prevent this kind of creativity and like refinancing and exchange offers. And there is like a real legal dispute about whether these changes can be done with or without unanimity, whether you need 100%
Right.
of the group, all three of us, to agree to a change in interest rate or principal maturity. Those are called the so-called sacred rights, if you will. And that's like a legal question that's been litigated, and we can talk about that more if you want. But then there's also the social aspect. And the social aspect is the idea that private equity firm X, they may have the legal ability for this mischief, but they ultimately wouldn't pursue that. And they wouldn't do that because they are a repeat player in the leveraged finance market. And if they get a reputation as a firm that gets too cute, that will cause them to borrow at higher interest rates down the line. And the next deal, the deal after that, the different partners who are not in this deal are going to face the consequences. Right. So there's a social aspect. And also within the deal itself, if you ultimately antagonize your creditors, down the road, you may need to restructure again. And if they remember you as the person who was rough with them, they're not going to be so kind when you need their help.
And yet Argentina exists.
Exactly. So that brings us to the private credit point. And you were obviously a leveraged finance reporter and a leveraged loan maven, and you know how that market works, which is it's really big. It involves banks who underwrite these deals and then they sell them on in the syndication process, and that's a whole kind of machine. And in a big leveraged loan credit, there's going to be dozens of CLOs and regular way mutual funds and then hedge funds, and it's like a widely dispersed kind of group, and that dynamic affects how the document is negotiated and just all the kind of interactions down the line. In a private credit deal where you truly have like a club or maybe even a single lender, where there's 4 or 5 or 3 or 2, maybe one firm that's providing a loan to a private equity backed company, that group is just much smaller. The negotiations around that document are much more intimate. And again, for those social reasons, there was the idea that in a private credit deal, the private equity firm sponsor who owns the company is not going to declare war or go to DEFCON 5 or DEFCON 1, whichever the highest one is, to pursue their own ends. It's going to be much more of a collaborative and kind
friendly,
and gentle process.
Kumbaya relationship.
Yeah. And so this, again, now we go to the examples of the creditor-on-creditor violence that has arisen now in the private credit market. And the examples are relatively sparse so far because private credit is relatively new. And two, I do think this kind of social dynamic actually is true. There's this case called Pluralsight, which Bloomberg has covered, the FT has covered, where in fact there was one of these aggressive kind of refinancing transactions that happened using kind of a loose document. And the private credit syndicate, which was 4 or 5 firms, was reportedly indignant that this had happened. In fact, this creditor-on-creditor violence situation was extremely mild. It was like one very small refinancing to make an interest payment, and then ultimately what happened was the sponsor handed the keys to the private credit firms to take ownership in a very bloodless way. And in fact, I wouldn't even I wouldn't even put this even close to the real headline-grabbing violence cases.
So let's say I am, there's some sort of club deal or there's some sort of deal, and I am a small holder, and I am aware of the existence of creditor-on-creditor violence as a risk. I perceive me as being the one who might get screwed, so to speak, at some point in the future. What am I doing along with my law firm to write that document in such a way so as to reduce my odds of finding myself in that position?
If you're a small player in the leveraged finance market now or a CLO, which is basically a passive instrument, as you guys know, which is these things that just accumulate loans and turn into securities, and you're not like a shark hedge fund, this leveraged loan market has changed quite a bit. And so if we just take a step back, leveraged loans are the most senior part of a capital structure, even in a levered company. And so what that means is even if things go south, the recovery rates in leveraged loans historically have been very high, like 80, 90, 100%. Okay. And so the people who hold these are relatively risk-averse institutions. And so 2 things have happened of one is this creditor-on-creditor violence concept, but also, as you alluded to earlier, this market is huge now, leveraged loans, relatively speaking. It's exploded in the last 10 years. And there are a lot of loan-only companies. There is nothing below the leveraged loan, other than the equity. There's no high yield bond. And so the recovery rates have become lower because there's less loss absorption below you. And this idea that conservative buyer over leveraged loan have bought the safest security and you have the first lien, the first claim on the assets, that idea has been eroded. And that's actually very profound. And this market has become much riskier than it used to be for the technical reasons and the social reasons. So getting to your question on what you should do about it, one, you have to ask yourself, do you want to be in this business?
Okay.
There's a lot of people who now, unless they're like one of the handful of really big players that can impact a distressed situation and actually be in the negotiating room, they're thinking long and hard about being in this business. And two, you do hope that the documents themselves are being tightened over time. And there are ebbs and flows in the market. There's supply and demand, and there's waves of when the documents are tight and when they're loose. And now you hear these terms about there's a J. Crew blocker.
Is there pushback now?
Yeah, there is. And there are these like they call these blockers, like the J. Crew blocker, the SERTA blocker.
And what are they? What does that mean?
And that just means that in the document, the lawyers will negotiate tighter terms and restrictions that prevent the J. Crew transaction, the SERTA transaction, and we can talk about this more in detail if you want. There is, again, this push and pull about, the documents and how tight or loose there are and how people push back. So, but the thing is, though, like everyone tends to be a price taker in these markets. And you kind of take the document that is the market at the time. And if you are a firm that tries to push back in the negotiations, they can just pass you over.
Right. There's plenty of others.
Yeah. Someone else will take the bad document when you won't. And that's the difficult dynamic right now.
So there's this great bit in your book where the lawyers are arguing over the meaning of "and" in a contract. That's
and
right.
Or, yes.
And or, like whether "and" means a bunch of conditions have to be met or maybe only some of them.
I've always thought in language this is a weird term because it's exactly right. It's often anyway. Yes, I've always thought this is a weird term. Sorry, keep going.
So personal aside, but my husband is a former corporate lawyer and it takes him ages to send a text message. Like he will spend 20 minutes writing a text message that's like 2 sentences, and he blames it on his legal background and the fact that you really have to consider the meaning of every single word. The thing I don't get about covenants and indentures and things like that is I would have thought a lot of it nowadays is like standard boilerplate. But I mean, the fact that these like issues arise and that there can be arguments over them suggests that maybe it isn't. So I guess my question is like, how much of this is standardized versus customized for particular companies?
Yeah, I mean, I think if we just take a step back and think about just like the industrial organization of these markets, and to your point, I think there was a sense that these documents are standardized and there's some kind of like template which you download and they're all kind of the same, more or less. What's happened is there has been now this arms race amongst the law firms and the investment banks to read these documents really carefully. And then in their laboratories in the basement come up with crazy transaction structure. So the big creditor-on-creditor violence techniques, there's something called the drop down. There's something called the up-tier exchange.
What are they?
There's something more exotic called the double dip. Something called pari plus. And these are like designed by these law firms and these investment banks. And when you do one of these transactions, you are not just checking a box saying, I want to do up-tier exchange, and something like it just happens. There's like 5 crazy things you have to do, which are kind of unnatural, and combined together create an up-tier exchange or a drop-down. And the result is all the same, which is you, senior lender, suddenly, if you're in the left behind group, collateral that you owned now is somewhere else and is not reachable to you. And what I've described are different techniques to do those things. And so people realize not only are the documents sort of looser, but the creativity that lawyers and bankers try to exploit has been accelerated and ratcheted up. And there's this idea that we're going to ask for forgiveness, not permission. We'll do the transaction. If someone wants to sue, we'll see them in court. That'll go on forever. And what you're ultimately trying to do in all these cases is create negotiating leverage for the actual settlement, where everyone will come into a room and, sort it out. But in fact, who has the leverage is determined by, who's in the group and who's not. So the actual transaction may or may not be important, but what it does is set the parameters for the ultimate negotiation.
So we've been talking a lot about behavior on the borrower and the lender side, but there is a sort of third party here, which is the court itself and the judges. And speaking of great books on credit, there's a great book on the Argentina restructuring that came out relatively recently called Default, the landmark court battle over Argentina's $100 billion debt restructuring. And one of the takeaways that I got from reading that book is so much depends on the judge that is put in charge of a particular case. And there are moments in that book where like the judge is just really tired and fed up with everyone. And so he kind of like does things kind of hastily, I guess. But what's been the response from the courts to more aggressive creditor-on-creditor infighting?
So that's a great question. And not just the actual like writing of the document the lawyers are doing is part of what the service they're offering. They're offering an entire kind of choreography on how this chess match is going to, like each chess move is going to unfold. We're going to the document to the actual like creditor-on-creditor violence transaction, and then ultimately the litigation and how can we game out each of these moves.
So like we'll be in this jurisdiction, we can expect maybe to get like this particular judge and the company or the other lender will respond this way.
Yeah, and so these documents are all now, almost all of them are written under New York state law. But that doesn't mean they always end up in New York state court. Sometimes they end up in New York state court. Sometimes they end up in federal court, where the federal court is interpreting New York state law. And then sometimes they end up in bankruptcy court, which is a federal court as well, and has its own like very kind of unique powers. And they end up interpreting the document. And there's a whole, again, art and science deciding how you think it's going to evolve. The state court and the federal courts are relatively slow. Bankruptcy courts are relatively fast. So like one case that's really interesting and I followed closely is this case Simmons from a couple of years ago, which is one of the emblematic creditor-on-creditor violence cases. And so this is a mattress company. Obviously, we all heard of it, got into trouble during the pandemic. They, in an effort to raise more capital, essentially went to their existing lenders and said, we need more money. Who can give us a deal? And this is a fun case because there end up being two competing groups, and they each propose their own deal. One is an up-tier exchange. One is a drop-down, essentially accomplishing the same things, which is new capital in the company, exchange of debt for a discount. And the company essentially had an auction for new capital. They picked one. So one group won. One group lost.
Wait, was it the up tier or the
so the up tier exchange group won.
Okay.
And there's a whole aside about this where the drop down group, which is Apollo and Angelo Gordon, very aggressive, smart firms that are in this market all the time, think the actual up tier structure is something that is actually legally offensive in a way a drop down is not. And that's a rabbit hole we can go down. But that's sort of that point is actually very interesting.
But they both essentially add like a new layer of debt to the capital stack.
Yeah, they both do the same thing. You end up in the same place. There's just a whole question of whether the up tier exchange is something that's actually contemplated in the original document. The drop down kind of is or not. And that we can go down that rabbit hole if you want. But the point is eventually CERTA had to file for bankruptcy. The Apollo Angelo Gordon group had sued in New York State Court. I can't recall if that ended up in federal court or not for jurisdiction reasons. But anyway, there was some lawsuit kind of going through the courts. There are multiple lawsuits about the transactions. Once the company went into bankruptcy, the company and the winning group sought to have the bankruptcy court declare the transaction permissible. And the bankruptcy court, which was very fast, the Houston court at the time were very, very fast, blessed the transaction, the bankruptcy deal got done, and the people in the winning group ultimately kind of took control of the company. The people left behind, got hosed for dimes on the dollar. So yes, so to answer your question, yes, the whole kind of legal game theory, the judicial is actually very important. And these questions are kind of often left outstanding and hanging because what happens is people ultimately settle out before you get final rulings.
Well, to add on to Tracy's question, has there been an evolution over time? So, okay, lawyers are racing to come up with new ideas and new interpretations of words. But in the dream world, you do transactions without ever really having to like redound to the document itself, right? Everyone is operating in good faith. We know what all these things mean. Hopefully you don't have to spend a lot of time looking at where commas are or what and/or actually means. has there been an evolution among judges in courts in terms of the degree to which they say, look, we know what these words mean. Why are you guys trying to redefine words versus, I guess, like a more literal, like, what do these words mean in the English language as described in the original document?
Yeah, that actually brings up an interesting point. If you read the actual complaints that like the losing group will write in their lawsuit, so they'll go through all their contractual points that you can't actually do this up-tier exchange and the 5 crazy things to get it done. And the very last count that they'll add to their complaint is something called the covenant of good faith and fair dealing. And that is the idea that, let's just put the words aside. What did these actually parties mean when they struck this transaction? Like, what was the actual intent? What was the spirit of the document? Right,
because in the end, we don't want to have to live in a world, right? I assume many investors, lawyers might, but investors probably don't want to live in a world where every comma and word is being challenged as its definition. And I'm curious if there's been some erosion of norms about the degree to which we sort of accept good people, investors accept, yeah, we all knew what this meant, good faith.
Yeah, and I think there is some level of exhaustion, and there have been some subsequent rulings where a court frowns upon the creditor-on-creditor violence transaction. There's this idea of also cooperation groups, which is this idea where the creditors, instead of like doing this 51-49 kind of fight, they all sign a contract to say, we're going to be one single block and we will negotiate as a group with the company. And there can be no creditor-on-creditor violence, because often what will happen in these deals is the sponsor will find the 51% group and they're in cahoots to do this thing, right? Now they're saying, you financial sponsor, don't do that, because we're all one group. And you can't pick any. You can't
so
pick
separately
any
separately from the bond doc or the loan.
Yeah,
document.
we'll say, we are not going to sign into a deal for the next 6 months or a year or till the maturity. And if the company wants to negotiate, they can negotiate with all of us as a block. So that's one thing. And there is now an effort to actually do what are called so-called pro rata transactions, where there is a refinancing, but the entire group, Tracy, Joe, Sujeet, all get a chance to participate.
What happened to the leveraged lending guidance? Because you alluded to how big this market is earlier, and it's huge, and it's been booming since like the 2010s. And I remember at one point regulators seemed concerned, and so they issued these guidelines of how to do leveraged loans and, like what kind of leverage you should have. And I remember a bunch of bankers freaking out about them at the time, but it doesn't seem to have had much of an impact.
So that was just the idea that a bank couldn't extend a leveraged loan where the debt to EBITDA ratio was more than 6 times. And that was because, it's a bank and they shouldn't do these risky deals. So a couple things happened. One, there's just a whole non-bank market. 2, there's some banks like Jefferies that are not subject to these guidelines. 3, there's this private credit, which is, a whole different world, which is obviously not regulated by banks. And 4, I think banks, found ways to push the limits or change the definition of EBITDA. But even 6 times, if you go up to 6, that's like a lot of leverage. And, even if you're doing it 6, banks themselves, I think, there's a story in somewhere about Citibank or Citigroup, which hasn't been a big player in leveraged loans. It's been kind of usurped in market share. Now suddenly has a new guy from JP Morgan. There's a story yesterday in the Journal, I think, about how he's going to push to get more into the leveraged loan market. There's a reason Citi is not like aggressive in this, because, it's risky, right? So we'll see how that works out for them. So yeah, there is the actual idea of, how much leverage is there total, and then, then these kind of interpersonal dynamics once the loan is extended.
As a former banker, again, you mentioned the law firms come in, they have new ideas, up-tier exchange offers, asset drop-downs, et cetera. They have the whole choreography of how it's going to play out, et cetera. These are skills that they bring to the table that are something different from valuation and, debt dynamics and so forth. Is that visible in the pie? There's a certain amount of money that gets spent every year on services for transactions by companies, by borrowers or lenders, et cetera. Has there been a shift in the tilt of the pie of like how much goes to lawyers versus how much goes to the deal makers?
Yeah, that's a great point too. So You've now all seen these stories about the law firm wars, the lawyers getting paid $20-30 million a year, and they're shifting firms like baseball players or like hedge fund guys typically do. And that's unusual because historically, if you started at a law firm as an associate and you made it to partner, you stayed at that firm your whole career, and it was prestigious, and you got a huge pension. You made a few $1 million a year. It was less than being a banker and less than being, a hedge fund star, but it was a stable and respectable job.
Interesting.
So now there is this like warfare because there are a set of lawyers who matter in this world and who specialize in private equity and are thought to be, the big brains around these crazy contracts. So that is something that's happened. And also, and this is actually the accompanying point, which is really interesting, the hedge funds and the private equity firms and the investors in this market, the people who actually put money to capital, they are increasingly horrified how much lawyers cost.
Oh, yeah.
How much bankers cost, how much the whole kind of process costs. Like in bankruptcy, if you do end up filing for bankruptcy, there is transparency because your fees are approved by the court. And you can see now there's lawyers who are charging $2,500 an hour. There's bankers who are getting success fees for, a pretty standard deal for like $50 million. Like WeWork, for example, a relatively small company at the end of the case, $750 million. There was, something like $100 million in fees.
Wow.
And there is real money in these kind of professional services in a way that is relatively new. And the costs are so much that it's affecting the returns of these funds. And they're thinking kind of proactively, how can we limit the damage? Because it's affecting, how much we're going to make in the deal ourselves.
If I'm a distressed debt investor in the current environment, would it be better to be really good at valuation and math or be really good at reading legal documents?
Yeah, I mean, I was going to wonder. It's like if our lawyer, makes sense. Why doesn't a lawyer just start a hedge fund? Anyway, keep going.
There are a lot of lawyers who start hedge funds. I do think, though, that this kind of the legal creativity, that is becoming a little bit commoditized. And ultimately, if you're going to make a lot of money, it's going to be less on a technical factor. And that the technical part, I think, is defensive. Ultimately, to make money, I think you have to be an entrepreneur and have a thesis around how is this business going to turn around? And if I end up owning it, how do I grow the market share and have more customers and that really kind of commercial business aspect. And there are cases, like Hertz, I think is a great story. That was a big bidding war during the bankruptcy, and there was 2 competing private equity firms with different plans for growing the business. And that stuff, I think, ultimately is important. The gamesmanship, again, truly defensive, and it's hard to differentiate yourself consistently. It is interesting now in this market to see in one deal, XYZ famous hedge fund is on the outs, the other one they're in the in, and that's kind of a coin flip. And for that reason, you just don't know how it's going to. You think you're in the winning group, and then you wake up and you see the press release, and you're not. That's a hard way to make a living. It's a hard way to sleep. And I don't know how long that will continue.
I'm going to ask a devil's advocate question, but one of the arguments that used to come up with the rise of cov-lite loans was this idea that, well, maybe it's actually a good thing for companies because they get more flexibility and there are more options available to them in terms of raising capital. On the other side, maybe there is like a long-term cost associated with like legal wrangling over every single deal, what Joe was kind of alluding to. Where do you fall on that argument? Is this ultimately good for companies, or is it a bad thing because maybe it makes people feel a little bit different about capital markets?
Yeah, so if we go back to like the Certa case, which I think is a good example. Again, you've got 2 competing groups, 2 aggressive transactions, and someone's going to win, someone's going to lose, and someone's feelings are going to be hurt, and there's going to be litigation. But from the company's perspective, you have an auction, and you're trying to get the lowest cost of capital for the $100 million that you need. And who wins or who loses to you doesn't matter. And this whole kind of distributional point, who wins, who loses, like, why do any of us care if famous hedge fund X is on the outs in this deal and in that deal and the winning side of that deal? That doesn't really matter. But if a company can raise capital at the best terms and avoid bankruptcy, that seems like a social positive. The points to temper that are 2 things. One, does the overall cost of capital go up? Because
if the investors are getting less returns because they have to factor in their legal fees, that sounds like higher cost.
Yeah, less returns, and there's some chance you're just going to you hold a senior loan and you're going to be at the bottom of the totem pole, and and you're just a boring CLO. That's going to be seems bad. And then two, if the company, this is something that we're seeing a lot of, if the company ultimately does file for bankruptcy and ends up in bankruptcy court, you end up with this Frankenstein capital structure where you have super senior, first lien, 1.5 lien, third out, and the bankruptcy court and the bankruptcy process has to figure out what the actual order is. There's probably litigation.
That happened with Caesars, right?
It did. I mean, Caesars, there is a little bit of creditor-on-creditor violence, which again is the idea of inter or intra conflict. Caesars is more the classic case where you have a fight between the equity holders, the junk bond holders, and the senior loans. Yeah. And there are people who are holding all
But
the
I
things.
just mean, in terms of having a capital structure that was so complicated that the bankruptcy court was struggling to understand it and deal with it. Caesars is a good example.
You the company before bankruptcy is trying to lower its cost of capital by selling all these bespoke securities for this particular type of investor. And it seems like a good idea at the time, and it maybe is. But then when you're actually trying to divide up a shrunken pie, that is a mess. And that process ends up being very costly. And we've seen cases where there is a creditor-on-creditor violence refinancing, and then 6 months later, the entire company is in bankruptcy, and the bankruptcy is much more complicated. T+6 months rather than if they had just decided to do it on day zero.
This is always the crazy thing when I think about distressed stuff is man, there's just a risk that it all everyone is trying to eke out their extra pennies or extra dollars, but you could really just collapse the whole thing.
Yeah, you're picking up pennies in front of the steamroller, and that is bad.
So speaking of Caesars, there's one more question I wanted to ask you, which is, what's the deal with Apollo? Can you just explain Apollo to me? Because they seem to be everywhere nowadays. I see headline after headline about what Apollo is doing, what they're thinking about doing. What's your take?
Yeah, I mean, I think they're the most interesting example of the broader theme in either alternative assets or just private capital generally. And that there are a set of firms that started out as in the 80s or 90s as leveraged buyout firms. They bought whole businesses or carve-outs of big businesses. As an equity player, they borrowed a bunch of money, they owned the company, they managed it, and they sold it 5 years later, ideally at a big profit. That's a great business. You can make a lot of money, pretty risky, but it created a lot of billion-dollar fortunes. But there is a limit on how many companies you can buy, and these firms have realized that they have such expertise in negotiating valuation, understanding businesses and business models, and just being creative generally, that the credit markets are just much bigger. And you couple that with the idea that the banking sector has undergone massive systemic changes post-financial crisis, and those businesses are much more constrained and complicated and not equipped, maybe for the modern capital market. So they have, for lack of a better phrase, used regulatory arbitrage to encroach into every aspect of lending. And that is allowing them to, become trillion-dollar managers. And that is a sea change, whether it's good or bad, too soon to say. But, Apollo is the clearest example, a firm whose heritage is in credit, coming out of Drexel. But in fact, credit markets are much deeper, much wider, and there's just much more opportunity to build a massive firm, and that's what they're doing.
All right, Sujeet, thank you so much for coming on All Thoughts. Truly the perfect guest, and I cannot recommend your book enough. So everyone who's listening, definitely go check that out if you haven't already. Joe, I thought that was so good, and I feel like I have a lot more clarity about what's going on now. I did think that the social aspect that Sujeet brought up is really interesting because, okay, obviously cov-lites became more of a thing, and then you had higher interest rates in recent years, and so more companies were under pressure, and maybe they got more creative in how they're raising capital. But I do think the difference or the change in social behavior on the part of investors is also a big part of the story. And so I guess the question is whether or not it could change again, to Sujeet's point about maybe having investors team up and have their own contracts about how they're all going to work together and things like that.
No, I thought there were some really interesting social questions arising out of that. And, I'm not a lawyer, but it does not, so I'm biased because, I'm not the beneficiary of this trend, but it does not seem great to have a ton of, human hours devoted towards the definition of and or things that we all thought we knew the definition of, et cetera. But actually, technically, if you look at and or, then the second one has to be in there because that's how I've always read it too. But maybe we thought it meant something else, or maybe we just thought it meant and whatever.
Hire Joe for your litigation.
I'm glad you brought this up. This has always bothered me. And it's interesting to think like it's actually eating into the returns, these legal costs, that it actually, even setting aside an incident of creditor-on-creditor violence, or even setting aside an incident of bankruptcy, that it would eat into returns just because of how much you're paying the law firms to go over every one of these legal documents.
It is crazy also just to think about like the amount of brain power that's being spent on debating this. And again, that's something that comes through in Sujeet's book, like how much people are thinking about this. And it certainly comes through in the Argentina book, just how like mentally taxing and time consuming sorting this stuff out is.
I thought it was also a really interesting point about the sort of, I don't know if it's like diseconomies of scale from capital efficiency, right? So you have all of these different instruments. You have equity, you have junk bonds, you have all the, super plus, whatever. And individually, each one of these transactions is designed to be the most capital efficient, to align the company's borrowing needs with the investors' needs. But then you end up with this sort of, Frankenstein's monster of a capital stack. And in the event that has to be unwound, that is not, it's like a tail risk, right? That emerges, that in the event that has to be unwound, it'll be a much costlier process than had it simply been equity and bonds or something like that.
Yeah. I mean, there can be like a parent company, an operating company, like convertible bonds, the loans, preferred stock, like it can go on and on and on. And someone has to go through all of that. Okay. Well, on that note, shall we leave it there?
Let's leave it there.
This has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me at Tracy Alloway.
And I'm Joe Weisenthal. You can follow me at The Stalwart. Follow our guest, Sujeet Indap. He's at S. Indap, and check out his book. He is the co-author of The Caesars Palace Coup, came out in 2021. Follow our producers, Carmen Rodriguez at Carmen Armin, Dashiell Bennett at Dashbot, and Cale Brooks at Cale Brooks. Thank you to our producer, Moses Andam. For more Odd Lots content, go to Bloomberg.com/oddlots, where we have transcripts, a blog, and a new daily newsletter. And you can chat about all of these topics 24/7 in our Discord, discord.gg/oddlots.
And if you enjoy Odd Lots, if you like it when we dig deep into creditor-on-creditor violence, then please leave us a positive review on your favorite podcast platform. And remember, if you are a Bloomberg subscriber, in addition to getting our new daily newsletter, you can also listen to all of our episodes absolutely ad-free. All you need to do is find the Bloomberg channel on Apple Podcasts and follow the instructions there. Thanks for listening.